Group. Towards the end of the decade, Kotani undertook a number of bold stock market operations, ramping, cornering and greenmailing. Working closely with another leading speculator, Akira Kato, head of the Seibi Speculator Group, Kotani lured politicians, company directors, yakuza and bank executives into his speculative web. Kotani's modus operandi was to exchange stock tips for favors. Before ramping Janome sewing machine, he provided inside information to Toshiyuki Iwamura, a leading member of the ruling Liberal Party and former head of the Environment Agency. In return for bank loans of 15 billion yen, $112 million, he leaked the same information to employees and customers of Mitsui Trust. For his assault on Kokusai Kogyo, an aerial survey firm, he received the support of 4 directors of the firm, to whom he lent money to buy Kokusai's stock. In exchange for a loan of 100 million yen, Kotani gave inside information to a leading businessman, Hirotomo Takei, the head of the Chisan group of companies, and former president of a leading newspaper, the Yomiuri Shimbun. An aide to the former Prime Minister, Yasuhiro Nakasone, was also brought in on the deal. Kotani then turned to a branch manager of Sumitomo Bank, who persuaded some of his bank's clients to provide Kotani with loans of over 20 billion yen, $150 million, to finance the deal. The unofficial lenders were offered high rates of interest, and the bank manager received a generous commission. Having successfully taken control of Kokusai Kogyo, Kotani found himself weighed down with debts. He attempted to solve his problems by manipulating the stock of a holiday tour company, Fujita Tourist Enterprises. For this operation, he demanded a 30 billion yen, $224 million loan from the Janome Sewing Machine Company, on whose board he sat. When Janome's president demurred, he was told that 2 hitmen had been employed in case the money was not forthcoming. Kotani also threatened to sell his own stake in Janome to gangsters. The president soon capitulated. Janome supplied the money and assumed responsibility for a further 187 billion yen, $1.4 billion, of Kotani's debts. To mark his absolute authority, Kotani placed orders for Fujita shares from the Janome boardroom and sent out the company's executives on his stock market errands. He proceeded to manipulate Fujita's stock by placing buy and sell orders through a number of brokers at escalating prices. In late April 1990, Fujita's share price shot up from 3,700 to 5,200. Once again, Kotani received insider assistance from an employee of his victim. He was also supported by 2 construction companies, one of which contracted to buy the shares at their peak. More than any other individual, Kotani showed how easily traditional Japanese networks could be redirected for speculative purposes. The Bubble Lady. Since speculative manias tend to undermine established structures, it was fitting that in this male-dominated society, the greatest private speculator should have been a woman. Born in 1930 into a poor family, Nui Onue began her working life as a waitress in the entertainment district of Osaka, Japan's second city. Later, she became the mistress of a construction company executive, who helped her purchase 2 restaurants in the mid-1960s. For the following 20 years, Mrs. Onue ran her restaurants without attracting notice. Then, one spring day in 1987, she entered an Osaka branch of the Industrial Bank of Japan and purchased over 1 billion yen's worth of the bank's discount bonds. Mrs. Onue proceeded to borrow nearly 3 trillion yen, $23 billion, a sum roughly 1,500 times the value of her restaurants, which she invested in the stock market. She soon became the largest individual shareholder in a number of blue-chip companies, including the Industrial Bank of Japan and Dai-ichi Kangyo Bank. She also took large stakes in Sumitomo Bank, Daiwa Bank, and NTT. Each shareholding was used as collateral for bank loans, which enabled her to buy more shares. Banks and brokerages fell over each other to do business with the Bubble Lady. Despite rumors of her gangster connections and burakumin, low-caste origins, Mrs. Onoway's restaurant was visited by many leading financiers, including the president of the revered Industrial Bank of Japan. Yamaichi Securities even kept an employee in permanent residence at the restaurant. Unsurprisingly, this attention soon went to her head. She became an inveterate name-dropper, ordered senior bank executives around like servants, and telephoned junior staff in the middle of the night to command their immediate attendance. Known as the Dark Lady of Osaka, Mrs. Onowa was a member of Mikyo, an obscure Buddhist cult. Once a week, she held an all-night séance in her restaurant, summoning the spirits to assist her speculations. Brokers were expected to attend these séances or risk losing her business. At dawn, she would inform them of the names of the companies revealed to her. In the heady days of the bubble, such behavior was accepted without question. With a fortune rumored at 500 billion yen, she liked to boast that, with money, all is possible. A new golden age. The bubble economy promoted a massive increase in consumer expenditure as the Japanese people forswore their post-war frugality. Rising asset prices, producing what economists term the wealth effect, combined with the stronger yen to stimulate a craze for foreign luxury imports. Cuts in income taxes increased personal spending power. Encouraged by low interest rates, people took out fresh loans against the equity of their homes. Credit card circulation increased almost threefold, and consumer debt per head rose to American levels. The consumers of the bubble economy were known as the Shinjinrui, the new people, to distinguish them from their hard-working, low-spending, and long-suffering forebears. The Shinjinrui eschewed traditional fare as a gourmet boom arrived in Tokyo. New French restaurants served up foie gras, and homard à la Mauricienne, actually fried shrimps. Like the flappers of the 1920s, the female Shinjinrui displayed a taste for shorter skirts and greater sexual display in their attire as part of the new body-conscious cult. They drank Moscow Mule cocktails, despised salarymen for being dasai, styleless, spent their evenings in nightclubs, and consumed drugs, especially cocaine and ecstasy. An English stockbroker in Tokyo lamented that the Japanese wouldn't realize their shares were overvalued as long as they continued paying $300 for a glass of whiskey-flavored water in Ginza nightclubs. Seibu Seizon, the department store group owned by Seiji Tsutsumi, the brother of Japan's richest property owner, became a mecca for the Shinjinrui. Long before the emergence of the bubble, Tsutsumi had anticipated a change in national taste and had coined the term oishi seikatsu, delicious life, to market imported foreign luxuries. In the autumn of 1984, Seibu opened a new department store in the exclusive Ginza shopping district, selling designer clothes by Yves Saint Laurent, Hermès, Gianfranco Ferré, and others. The store's greatest novelty lay on the 8th floor, where shoppers could buy shares, precious metals, and property. Other department stores soon followed suit. Tsutsumi also opened a new hotel at No. 1 Ginza, whose decadent opulence might have made a robber baron blush. Its most expensive suite, supposedly modelled on the bedroom of the French actress Catherine Deneuve, contained a canopied bed covered with a silver fox quilt. Guests were offered a choice of 7 stuffings for their pillows, including artificial pearls. The hotel's chef came from one of Tokyo's best French restaurants, and its cellars were stocked with the finest French wines. Funny money, the bubble in the art market. The art world of the 1980s was subject to the increasingly aggressive behavior of its leading auction houses. Under new management since 1983, Sotheby's in particular worked hard to stimulate the demand for fine art. Potential customers were bombarded with glossy in-house magazines, and lavish parties were thrown to launch major sales. Sotheby's provided loans to buyers, the so-called art equity loan, guaranteed prices to sellers, and at times bought pictures for its own inventory. The auction house also went to great lengths to emphasize the investment potential of art, and published its own art market index, which recorded price changes in the different collecting fields. According to the art critic Robert Hughes, the creation of confidence in the investment properties of art during the 1980s became the cultural artifact of the last half of the 20th century. In fact, there was little new about art as an investment. Towards the end of the 19th century, Henry Clay Frick, the American steel baron and art collector, observed with great satisfaction that, even during possession, some paintings were seen to increase sometimes 100, 1,000-fold more rapidly than the certificates of the best-managed joint stock companies. Unlike stocks, however, paintings have no theoretical value. They produce no cash flows, no dividend yields, or price-earnings ratios to help collectors distinguish between prudent investment and rash speculation. Once a price for an artist's work has been established at auction, it sets the benchmark for all future valuations. As Hughes observed, art's prices are determined by the meeting of real or induced scarcity with pure, irrational desire, and nothing is more manipulable than desire. In the 1980s, the combination of ambitious Western auctioneers, promoting art with every trick in the book, and Japanese speculators, their wallets swollen with bubble profits, created the most extravagant art market on record. It was only after the appreciation of the yen following the Plaza Accord that Japanese collectors became the dominant force in the global art market. In 1986, the dollar value of Japanese foreign art imports quadrupled. Their purchases became headline news in the spring of 1987, when a Japanese insurance company, Yasuda Fire and Marine, paid just under $40 million for Van Gogh's Sunflowers, a figure nearly 3 times greater than had ever before been paid for a painting. The global stock market crash a few months later actually increased the demand for art, since Japanese investors became wary of international stocks. In the week after the crash, the world's most expensive diamond for $6.4 million and the world's most expensive printed book, the Estelle Doheny Gutenberg Bible, for $5.9 million, were sold at auction. In both cases, the purchasers were Japanese. The art market became progressively hotter, with the 15 months from October 1988 to January 1990 described as the most sensational that the art world has ever seen. Among the many trophies shipped to Japan during this period was Picasso's Les Noces de Pierrette, an unfinished painting from the artist's Blue period, picked up for $51.4 million by a flamboyant property dealer by the name of Tomonori Tsurumaki, a man given to lavishing $10,000 tips on art dealers. In December 1989, Sotheby's published the $1 million list, which revealed that during the previous month nearly 60 works had sold for more than $5 million each, and a further 300 paintings had fetched more than $1 million apiece. The art world called it the $1 billion binge. A few months later, Ryoei Saito, a paper manufacturer, bid $82.5 million for Van Gogh's portrait of Dr. Gachet and $78 million for Renoir's Au Moulin de la Galette. Saito even picked up a Renoir sculpture for a mere $1.6 million, as he said, for my backyard. By the end of the decade, it was calculated that the price of French Impressionist paintings had risen by more than 20-fold over the previous 15 years. During the same period, the Dow Jones Industrial Average had not even doubled. Henry Frick's observation on the investment potential of art appeared to hold true. Japanese art collectors were unsophisticated. A painting had to convey wealth and exclusivity, and above all be easily recognizable. While the Shinjin-rui kept to their bubble designers, such as Versace and Armani, the Japanese art speculators remained faithful to their brand painters, mostly French Impressionists and Post-Impressionists. When asked why he had spent over $300 million on late 19th century French paintings, Yasumichi Morishita, a moneylender known in his trade as the Pit Viper, replied, "Impressionist paintings go better with modern decor." This simple taste for iconic works both reduced the demands of connoisseurship, opening the market to all comers, and ensured that the speculative fervour remained concentrated, thus helping to promote the prices of selected artists. Masahiko Sawada, a car dealer turned gallery owner, once boasted to an arts magazine that he personally controlled the prices of Renoir. Finance companies provided margin loans for up to half the value of the artworks. Maruko, a real estate company, offered part shares in paintings. La Juive, a painting by Amedeo Modigliani, was valued at $12 million and divided into lots of $100,000. Maruko also set up a $5 billion yen fund to buy works by Picasso, Chagall, Renoir, and other masters. A spokesman for the company said that the fund's members, drawn from its established clientele of condominium and real estate speculators, don't particularly care about the identity of the artist when deciding to purchase a share in a work of art. What they want is not a painting, but a capital gain. Paintings were also used as collateral to raise loans to buy shares and property. They became a branch of Zytek, another financial instrument for the bubble age. The golf club membership craze. The confusion of investment with consumption that typified the art world in the second half of the 1980s was even more pronounced with Japanese golf club memberships. Played by nearly a third of all salarymen, golf was an important feature of the Shain Ryoko company outing. The game had acquired a ritualized significance in Japan. The different ranks of prestige accorded to golf clubs allowed members to display their hierarchic status, while businessmen, politicians, and bureaucrats used their time at the club to expand their jinmyaku, network of connections, which formed an integral part of social and professional life. Since golf clubs were owned by their members, when land prices soared in the 1980s, the property rights of club membership became increasingly attractive. In early 1982, the Nihon Keizai Shimbun launched the Nikkei Golf Membership Index, calculated from the average membership prices at 500 clubs. From a base of 100, the golf index reached 160 at the end of 1985. It doubled in the year after the Plaza Accord, suffered a correction in February 1987, but recovered to reach a peak of just under 1,000 in the spring of 1990. The Golf Index became a leading indicator for the illiquid Japanese property market. During the bubble, the cost of joining Tokyo's exclusive Kogane Country Club, restricted to Japanese males over 35 years of age, climbed from 100 million yen to 400 million yen, $2.7 million. Over 20 clubs cost more than $1 million to join. The total value of memberships in Japan was estimated at around $200 billion. The secondary market in golf club memberships was supported by 100 registered and several hundred unofficial brokers, who received a 2% commission on transactions. Brokers also solicited subscriptions for new clubs, of which over 1,000 were under construction in the late 1980s. Banks provided margin loans of up to 90% against the collateral of membership certificates. These certificates were also used to raise money to invest in the stock market. The golf craze spread abroad. Japanese property developers bought most of the golf courses in Hawaii and started planning many more. In September 1980, Cosmo World, a middling property company, purchased the Pebble Beach resort of hotels and golf courses in California for $831 million, a record-breaking sum that attracted a lot of attention from the "Japan is buying up the United States" doom-mongers. The booming art and golf markets, with their brokers, shares, market indexes, margin loans, corrections, and corners, parodied the manipulated and overpriced Japanese stock market. Both the art and golf markets involved a speculation in status as well as money. By combining the acquisition of status, Veblen's trophies of conspicuous consumption, with the frenzied desire for material improvement, the Japanese speculator resembled his 17th-century forebear. Van Gogh's sunflowers became the Semper Augustus tulips for a modern era. Towards the end of the decade, the bubble's explosive growth was viewed with growing concern in certain circles. The Japanese saw themselves as a cohesive society of middle-class citizens. Yet rising asset prices and the unevenly divided spoils of speculation created egregious disparities of wealth. The fortunes of the richest fifth of the population quadrupled during the bubble years, while those of the poorest fifth actually declined. The new ricci, nouveau riche, with their fortunes in stocks or property, had a counterpart in the new poor. Moreover, it appeared that most of the bubble's profits accrued to insiders, while outsiders shouldered all the losses. Thus the myth of classlessness was undermined. In the manner of traditional Western criticisms of speculation, the bubble was seen as eroding the work ethic by severing the connection between labour and reward. The Shinjin-rui, with their taste for luxury and credit, were increasingly resented by the older generation of frugal workaholics. In the type of language normally reserved for decadent Westerners, a Japanese research institute denounced the Shinjin-rui as Epicurean egoists. Through their acts of speculation, the new people of the bubble economy were subverting the established social hierarchy, just as in the 1690s the moneyed men of Exchange Alley had weakened a feudal order based on the ownership of land. The social consequences of the bubble economy were not intended by the authorities, who, when they belatedly decided to prick the bubble, did so more for reasons of social control than for fear of its harmful economic side effects. The speculator had shown himself to be a narikin, a person without rank in the hierarchy of Japanese society. He posed a danger to the delicate structure of the system. Eventually, it became necessary to remove him. The end of the bubble. As 1989 drew to a close, the Nikkei index was approaching the 40,000 mark, up 27% on the year and nearly 500% on the decade. The price-earnings ratio of the stock market was at 80 times historic earnings, having peaked at 90 in 1987. Shares yielded a measly 0.38% in dividends and sold for 6 times their book value. During 1989, shares worth 386.4 trillion yen, $2.9 trillion, changed hands, with daily turnover averaging around 1 billion shares. Outstanding margin loans approached 9 trillion yen, $67 billion, an 8-fold increase since 1980. The last year of the decade had also witnessed some of Japan's most ambitious foreign acquisitions. Mitsubishi bought Rockefeller Center in Manhattan for over $1 billion, and Sony invaded Hollywood with its $3.4 billion purchase of Columbia Pictures. Nomura Securities was forecasting that the Nikkei would reach 80,000 by 1995. Even the normally skeptical Far Eastern Economic Review was predicting another excellent year for 1990. Its analysis, however, overlooked a significant detail. At the end of the year, the governor of the Bank of Japan, Satoshi Sumida, a man seen by many as an ineffectual Ministry of Finance stooge, was replaced by Yasushi Mieno, a career central banker who liked to boast in public that he had never owned a share. Governor Mieno's personal mission was to prick the bubble. On Christmas Day 1989, he ordered another raise in the official discount rate, following an earlier increase in May. 4 days later, the Nikkei reached its all-time peak. The Japanese stock market did not collapse with a sudden jolt. There was no repeat of the 2 Octobers, 1929 and 1987. Instead, it gently let out air like a balloon left over from a Christmas party. By the end of January 1990, the Nikkei index had fallen 2,000 points. Although many Japanese blamed the decline on short-selling by foreigners in the stock futures market that had opened the previous summer, its real cause was a sharp tightening of monetary conditions. As property prices continued rising in the early part of 1990, Governor Mieno, who publicly expressed a desire to see property prices fall by the curiously precise figure of 20%, lifted interest rates a further 5 times, until they reached 6% in August 1990. With the yield on long-term bonds above 7%, compared to the average stock yield of under 0.5%, the Japanese stock market had nothing left to support it. Having manipulated the market on the way up, the mandarins at the Ministry of Finance attempted with less success to control its descent. In early February, the margin requirement on stocks was reduced from 70 to 50%. Yet a few days later, on the 21st of February, the Nikkei fell a further 1,200 points. A month later, the Big Four brokers, under pressure from the Finance Ministry, agreed not to make any further issues of shares or warrant bonds until the market recovered. Shortly after, the Nikkei dipped below 30,000 for the first time in 2 years, and the total capitalization of the Tokyo Stock Exchange fell behind that of New York. The authorities continued their efforts to support the stock market. Brokers were ordered to purchase stocks when the Nikkei fell below 20,000 in September 1990. Margin requirements were reduced to 30%. Life insurers were instructed to stop selling shares. The ban on new share issues was extended. Funds were diverted from public pension funds and postal savings account into the stock market, and a number of accounting scams were introduced to discourage institutional shareholders from selling stocks. Brokers derisively referred to these efforts as the price-keeping operation. They had little effect on the stock market, which revived briefly in October 1990 in a movement known as the dead cat bounce, and then continued sliding until it hit a low of 14,309 in August 1992, a decline of more than 60% from its peak. As the Japanese authorities refused to allow the prices of stocks and property to sink low enough to find their clearing level, the point at which buyers equaled sellers, they frustrated the market's ability to clear away its own excesses, what Schumpeter called creative destruction. Instead of alleviating the problems, the authorities' mismanagement succeeded only in drawing out the painful aftermath of the bubble. As we have seen, the same accusation has been directed at President Hoover's policies of the early 1930s. No longer were Western economics texts filled with wonder for the Japanese system and fulsome praise for its all-powerful ministries. In the summer of 1990, the corruption that had simmered away during the bubble years burst forth in a series of financial scandals. Nomura and Nikko Securities became enmeshed in a scandal concerning the compensation of corporate clients for losses in their Eigyo Tokin accounts, the speculative service run by brokerages for corporate clients, which provided a guaranteed rate of return. Although officially illegal, these accounts had been privately sanctioned by the Finance Ministry. Their existence was symptomatic of a system which favoured insiders. Such arrangements became less acceptable after the stock market went into decline. Once again, a scapegoat was needed to purge the collective sins of the community. In June 1990, Yoshihisa Tabuchi, president of the mighty Nomura, was forced to resign for his firm's role in the loss compensation scandal. It was the first of many ritualistic resignations in the financial world, intended to appease a vengeful public. The following year, it emerged that several brokers had avoided reporting losses by shifting them illicitly from one client's account to another, a practice known as tobashi. This time Daiwa and Cosmo Securities were implicated, and their presidents obliged to step down. In the summer of 1991, Fuji Bank was implicated in the forgery of certificates of deposit, credit notes, worth 260 billion yen. At around the same time, Mrs. Onoue was arrested after it was discovered that she had obtained 342 billion yen, $2.6 billion, worth of forged certificates of deposit from an employee of a small Osaka bank, and had used the forgeries to obtain loans from the Industrial Bank of Japan. In late October 1991, the chairman of IBJ resigned. A few months earlier, Mrs. Onoue had been declared bankrupt, thereby making the transition from being Japan's largest private investor to its greatest individual debtor. Other leading speculators were also brought down by the deflation of the bubble. In 1992, Mitsuhiro Kotani was declared bankrupt, with debts of 250 billion yen, $1.9 billion, having already been indicted for extorting money from Janome Sewing Machine Company. Subsequently, he received an 18-month suspended sentence for the naked manipulation of Fujita's shares, although the court declared that securities companies were partly responsible for his crime. By the time Kotani's web of speculation was fully unravelled, a high-ranking politician had been sent to jail, the presidents of 2 leading banks had been forced to resign, and several dozen others, among them politicians, gangsters, company directors, and stock market operators, had been implicated in his criminal operations. Public disgrace also came to Sumitomo Bank, the most profitable Japanese bank in the late 1980s. Driven by its ambitious chairman, Ichiro Isoda, known as the Emperor, Sumitomo had taken the values of the bubble economy to its core, massively expanding its loans to the property sector and using tokin accounts to enhance profits. The bank was deeply involved with Itoman, a trading company run by a former Sumitomo employee. When Itoman was enveloped in a scandal concerning forged painting valuations, illegal share support operations, and gangster-related property deals, Sumitomo was forced to bail it out at a cost of more than $2 billion. The bank was also linked to the gangster boss Susumu Ishii, after it was revealed that a Sumitomo branch manager had persuaded clients to make loans to Ishii to finance his failed corner of the Tokyu Corporation. Isoda took responsibility for this scandal and resigned in October 1990. For Sumitomo, the bubble's painful legacy continued. In 1994, Yakuza murdered a Sumitomo manager in an affair connected with failed speculations, and the following year the bank reported losses of 280 billion yen, $2.1 billion, as a result of bad loans made during the bubble years. Cosmo World's acquisition of Pebble Beach, in which Itoman had taken a stake, also turned sour. In early 1992, the company sold the California golf resort for a loss of more than $300 million. By then, the golf membership index had sunk nearly 50% from its peak. As the trade in golf memberships diminished, many golf brokers went under. Cancellations from hard-up members brought demands for refunds that exceeded 10 trillion yen, $75 billion in total. But many golf course developers had frittered away subscription funds in the stock market and now declared themselves bankrupt. Scandals soon emerged. The Ibaraki Country Club was raided by police after having sold nearly 60,000 memberships instead of an authorized 2,000. Likewise, the Gatsby Golf Club, with its fateful allusion to the 1920s high life, was found to have illegally increased memberships by 15 times its prescribed limit. It was also discovered that the gangster Ishii had raised 38 billion yen, $285 million, by selling fraudulent memberships in the Iwama Country Club, although this was a public golf course with no private membership rights. The art market suffered a similar fate. Numerous Japanese art dealers were convicted of crimes ranging from tax evasion to racketeering. After Itoman collapsed in October 1990, it emerged that its property subsidiary had purchased thousands of paintings whose valuation papers had been forged. These paintings had been used as collateral for fresh loans in an attempt to circumvent the rules restricting loans to property. The leading art speculators ran into trouble. In March 1992, Masahiko Sawada, the man who tried to corner Renoir, was declared bankrupt with debts of over $600 million. His 2,000 paintings were appropriated by a bankruptcy court. Yasumichi Morishita's gallery, Asuka International, closed in 1994, and its collection of paintings, once valued at 30 billion yen, was taken by creditors. Because finance companies did not wish to realize losses on their loans by selling depreciated paintings, they crated them and stored them away from the public eye. As a result, many famous pictures simply disappeared. When the National Gallery in Washington attempted to borrow Picasso's Les Noces de Pierrette for an exhibition in 1997, the museum was unable to locate either the painting or its current owner. Decline and fall. the collapse of the Japanese banking system. The dream that Tokyo would emerge as a global financial capital declined along with share prices. Several large American companies, including General Motors, delisted from the Tokyo Stock Exchange. After turnover in the stock market ebbed to a tenth of its bubble peak, several foreign investment banks sold their seats on the exchange. Many of the famous Japanese overseas investments, including Mitsubishi's stake in Rockefeller Center, were put up for sale at knockdown prices. After the nationalistic hubris of the bubble years, Japan was in full retreat. The Japanese economy headed towards recession. Enormous capital expenditure, the product of cheap capital during the bubble years, had saddled the country with excess productive capacity. Consumer spending, the other great prop of the bubble economy, declined as the wealth effect reversed direction. The government announced a succession of fiscal boosts to stimulate the economy and revive the stock market. Monetary policy, having been kept too tight for too long, was also loosened. The official discount rate was successively cut until in September 1995 it reached an all-time low of 0.5%. The rate remained unchanged until September 1998, when it was cut to 0.25%. Shortly after, foreign banks began offering negative interest rates on their yen deposits. In other words, Japanese depositors paid for the privilege of lending their money to overseas banks, which they considered safer than their own. Yet low interest rates failed to bring the market to life. As Keynes had observed during the Great Depression, in deflationary conditions, monetary policy was no more effective than pushing on a piece of string. By late 1992, property prices in central Tokyo had fallen 60% from their peak. A banking crisis, caused by the bank's excessive exposure to the falling property market, loomed. At the time, analysts suggested that their bad debts might be as high as 60 trillion yen, $450 billion. Property prices continued falling throughout the middle of the decade, with commentators warning ominously of a debt deflationary spiral similar to that of America in the 1930s. In August 1995, Japan experienced its first bank run of the post-war period, when depositors withdrew 60 billion yen from a stricken Tokyo credit union, Cosmo Shinyo. This was followed shortly after by a run on a large Osaka credit union and the collapse of Hyogo, a small bank in earthquake-struck Kobe, which became the first listed bank to fail in half a century. Lines of panic-stricken depositors jostling for place in front of tearful cashiers summoned up remembrance of earlier, seemingly less stable periods in the history of capitalism. Towards the end of 1995, the government was obliged to bail out several housing loan companies known as Jusen, whose losses of 6.4 trillion yen, $48 billion, came largely from gangster-related lending. In November 1996, the authorities allowed Hanwha Bank to go to the wall. 12 months later, Sanyo Securities became the first Japanese brokerage to fail since the Second World War. It was followed in the middle of November 1997 by the closure of Hokkaido Takushoku Bank, Japan's 10th largest bank. On the 21st of November, Moody's, the U.S. credit ratings agency, downgraded the debt of Yamaichi, one of the Big Four brokers. Yamaichi was rumored to have concealed losses offshore. Rapidly, the broker lost the confidence of the market and was unable to roll over its short-term debt. On the 23rd of November 1997, exactly 100 years after its foundation, Yamaichi Securities announced its closure. With estimated liabilities of 3,200 billion yen, $24 billion, it was the largest bankruptcy in Japanese history. A few days later, a Japanese stockbroker threw himself from the top of a Tokyo skyscraper. According to the newspaper reports, he had been unable to live with losses caused by Yamaichi's collapse. 9 years after the collapse of the bubble economy, Japan teetered on the brink of a systemic collapse, its banking system weighed down with bad debts of an uncertain magnitude, its companies reporting record losses, and its consumers too frightened to spend. As the stock market declined, the bank's capital base, composed in part of the profits on their shareholdings in other companies, shrank. The hidden assets of the 1980s became the hidden losses of the 1990s. When the Nikkei briefly touched 13,000 in October 1998, it was estimated that among Japan's 19 leading banks, losses on cross-shareholdings had reached 5 trillion yen, $38 billion. In September 1998, Standard & Poor's, the U.S. ratings agency, estimated that bad loans in the banking system were around 150 trillion yen, $1.1 trillion, despite write-offs totaling billions of yen in the intervening years. The resulting credit contraction threatened to deprive firms of working capital. By this date, the post-bubble revulsion against stocks was so complete that over 60% of Japanese personal assets were committed to cash, bearing interest of less than 0.5% per annum. The crisis of the Japanese system. The Japanese bubble economy conflated notable features from several past speculative manias. The art and golf market booms recall the Dutch tulip speculations of the 1630s. Just as the first financial revolution produced a speculative boom in the 1690s, so the bubble economy of the 1980s was partly the result of the modern financial revolution following the collapse of Bretton Woods. Economies in the process of liberalization appear to be especially susceptible to outbreaks of speculation. The warrant bonds issued by Japanese companies, with their conversion rights into ordinary shares, were reminiscent of the conversion of annuities into South Sea shares in 1720. In both cases, a circularity existed, so that when shares rose, the value of conversion rights, of annuities in 1720 and warrants in the 1980s, appreciated, which in turn made the shares more valuable. The modish theme speculations, from miracle cancer cures to AIDS drugs derived from chicken bile, are redolent of the more absurd bubble companies of the South Sea year. Allowing Japanese banks to count their shareholdings as capital, thereby linking credit creation to share prices, recreated the same flaw that destroyed John Law's Mississippi system in 1720. Manipulation and corruption in the poorly regulated Tokyo Stock Exchange stimulated the kind of speculation common in the United States during the Gilded Age and the 1920s. Extravagant foreign acquisitions by Japanese corporations during the bubble economy were foreshadowed by American overseas purchases during the boom of 1901, when the United States overtook Britain as the world's leading economic power. In both cases, speculation was propelled by hubristic nationalism. The aftermath of the bubble economy, with its financial scandals, asset deflation, banking crisis, and prolonged economic malaise, finds its closest historical parallel in the American experience of the Depression years. Perhaps more than anything, the bubble economy illustrates the danger that arises when investors believe that market risk is shouldered by the government rather than by themselves, what economists refer to as the problem of moral hazard. Throughout the late 1980s, skeptics were told that the Japanese government would not allow share prices to fall, and that Japanese banks and brokerages were too big to fail. When the bubble collapsed a few years later, this belief was revealed for what it was, an ignis fatuus that had led the banks to their ruin. The problem of moral hazard is not new to the financial world. The Japanese authorities' support for an overvalued stock market harked back to 1720, when British shareholders believed that their government's sponsorship of the South Sea Company would protect them from loss. More recently, in the spring of 1997, there was a mad rush to invest in red chips, companies operating in mainland China and quoted on the Hong Kong Stock Exchange. The main allure of the red chips was their association with Chinese politicians, who, it was argued, would not allow their share prices to fall once the former colony came under their control. In May 1997, the share issue at the flotation of Beijing Enterprises, a start-up operation connected to the Peking municipal government, was 1,000 times oversubscribed, with the total value of subscription checks exceeding the Hong Kong money supply. Yet a few months later, Beijing Enterprises was down more than 60% from its peak, and the red chips had lost their sheen. The appearance of the too-big-to-fail argument in speculative markets is a fairly reliable harbinger of crisis. The Japanese economic system, with its emphasis on consensual values, was meant to be different from the freewheeling capitalism of the West. Despite the global financial revolution, Japanese corporations remained subject to a high degree of bureaucratic intervention. The bubble economy showed how the fever and contagion of speculation could infect even a tightly controlled economy, as long as its capital markets were relatively free. When the bubble economy ended in financial crisis, it proved impossible to return to the status quo ante. The essential components of the Japanese economic system, centralized industrial planning, administrative guidance, the authorized cartels of Japanese industry, cross-shareholdings, keiretsu groupings, lifetime employment, promotion by seniority, high personal savings, and the long-termist pursuit of market share above short-term profitability, were increasingly questioned and threatened with dissolution. In the hope of solving the financial crisis, the authorities were obliged to promise more deregulation and tighter supervision of the financial markets. With its characteristic disregard for tradition, speculation had brought its anarchic qualities into play and destroyed the Japanese system with its myriad restrictions. Just as Commodore Perry's black ships forcibly ended Japan's self-imposed economic isolation in the 19th century, so the aftermath of the speculative maelstrom is forcing Japan to converge with the Western economic model. In future, the invisible hand will assert itself, and Japan, the land of 3 seasons, will not be so different. Epilogue. The Case of the Rogue Economists. The ideas of economists and political philosophers, both when they are right and when they are wrong, are more powerful than is commonly understood. Indeed, the world is ruled by little else. Practical men, who believe themselves to be quite exempt from any intellectual influences, are usually the slaves of some defunct economist. Madmen in authority, who hear voices in the air, are distilling their frenzy from some academic scribbler of a few years back. John Maynard Keynes, The General Theory, 1936. Privatizations and stock market capitalism were essential components of the New World Order after the disintegration of the Soviet Union. The opening of new stock markets from Warsaw to Mongolia, the free movement of capital, and the unfettered trade in foreign currencies that characterized the early 1990s were welcomed by economists and Western politicians alike. After centuries of controversy, it appeared that speculation had finally achieved respectability, according to the authors of A History of Wall Street, published in 1991. Now, however, no opprobrium beclouds the activities of those who seek stock that will show the greatest price increase over the shortest time period, precisely that for which the old-time speculators were condemned. Speculation has come of age. It can sit quite comfortably side by side with investment, and it is as legitimate and necessary as the securities markets themselves. In economics textbooks, speculators were now portrayed as benign economic agents who helped markets assimilate new information and made markets efficient. According to modern economic theory, speculators serve to increase the productive capacity of an economy by providing liquidity in the financial markets, thus reducing the cost of capital for companies. The benefits they bring are not confined to the domestic economy. Their resourcefulness and ingenuity take speculators abroad, where they bring liquidity to the stock markets of developing nations. Again, the effect of speculation is to provide capital for local companies, promote growth, and contribute to the optimal allocation of resources on a global basis. Speculators are credited with assuming the risks inevitable to the capitalist process. In the early 1950s, Professor Julius Grudinsky of the Wharton School of Business remarked that investors in common stocks are the genuine risk-bearers in the system of capitalism and free enterprise, as nobody knows what future profits will be. The speculator's appetite for growth stocks enables the entrepreneur to raise capital in the stock market, what has recently been called IPO capitalism. More companies are founded as a result. Speculators may lose money on occasion, but the economy as a whole prospers by their activities. Professor William Sharpe, a Nobel laureate, has argued that the increased appetite of Americans for stock market risk in the 1990s was producing a more dynamic economy. Federal Reserve Chairman Alan Greenspan agreed. In November 1994, he announced, "The willingness to take risk is essential to the growth of a free market economy. If all savers and their financial intermediaries invested only in risk-free assets, the potential for business growth would never be realized." Speculators also scrutinize the policies of governments to judge whether they are sustainable or even wise. They make politicians accountable to the people. In an interview with the Financial Times in November 1997, the Chinese dissident leader Wu Kaizi claimed that the establishment of the stock market in China was creating a civil society. The stock market has that magic power that makes people concerned about the country's economic policy. Once the will of the people is awakened, they will not sleep again. In the early 1990s, Britain was sunk in a recession that appeared to be without end. It was caused by her political masters linking sterling to a basket of European currencies dominated by the Deutsche Mark. Owing to the inflationary effects of German reunification, this policy inflicted on the British economy far higher interest rates than domestic conditions warranted. On Wednesday, the 16th of September, 1992, the financier George Soros, manager of the Quantum Fund, came to the rescue of British industry by taking massive bets against sterling, thus forcing a devaluation and knocking Britain out of the European rate mechanism. This resulted in lower British interest rates and was followed soon after by economic recovery. Black Wednesday, on reflection, became White Wednesday, a day to celebrate. Speculators also serve to discipline the behavior of corporate managements, making them more accountable to their shareholders. They seek out value, rewarding companies which create value with high share prices, and punishing companies that fritter away their shareholders' funds with low share prices. Out of this has emerged the cult of shareholder value, the management fad of the 1990s, which asserts that executives' prime consideration should be their company's share price. Because the interest of management is nowadays more closely aligned with shareholders through executive stock option schemes, speculators effectively determine the level of management compensation. They hold the whip and will crack it when necessary. Trend-following speculation. These arguments in favor of speculation are predicated on the assumptions that markets are inherently efficient, and that the actions of speculators are both rational in motivation and stabilizing in effect. The efficient market hypothesis rests on the observation that stock movements are unpredictable, since at any moment shares reflect all information relevant to their value, so that their prices change only on the receipt of new information, which by its nature is random. As we have seen, this so-called random walk theory is incompatible with the notion of stock market bubbles, since during bubbles investors react to changes in share prices rather than new information relating to companies' long-term prospects, what economists call the fundamentals. Such behavior is termed trend following, and there is ample evidence that it has been a key feature of the financial markets in the 1990s. In the American stock markets, trend-following speculation has recently acquired a new name. It is called momentum investment, and has been popularized by best-selling investment books, which advise buying stocks that are rising and selling those that are falling. These stocks are said to exhibit, respectively, high and low relative strength. Momentum investment has acquired a multitude of followers, particularly among the Internet day traders, who use their immediate access to the market to execute lightning trades. This strategy has produced great volatility in individual stocks, especially those of high-tech companies, which have become the speculative footballs of the late 20th century. Recent experience suggests that foreign currency markets are also dominated to an unhealthy degree by the trend-following behavior of professional traders, who have the ability to create self-fulfilling currency crises. When a financial crisis afflicts an emerging market nation, foreign exchange dealers rapidly re-examine the economic situation of its neighbors. They realize that if one of these countries were to suffer from a loss of confidence, interest rates would have to rise to protect the exchange rate. Higher interest rates, in turn, would exacerbate any fiscal weakness of the government by increasing its cost of borrowing, and also cause local asset prices to fall, damaging local banks and businesses. The net result of these events might lead to a currency devaluation, possibly accompanied by a full-scale financial crisis if banks and local businesses have borrowed excessively in foreign currencies. Thus, a nation which is otherwise sound can have its economy seriously damaged by a sudden and contagious loss of confidence. Having weighed these considerations, traders realize there is little to gain by continuing to hold the currency of such a country. Selling the currency short becomes, in trading terminology, a no-brainer. The ability of trend-following speculators to create self-fulfilling prophecies was witnessed after the Mexican crisis of late 1994, when a crisis of confidence swept through other emerging markets. The so-called tequila effect came to an end only after the United States and the International Monetary Fund arranged a massive bailout for Mexico. Just over 2 years later, the devaluation of the Thai baht in the summer of 1997 sparked off currency devaluations and stock market crashes across East Asia, even though some economists asserted that the loss of confidence was not justified by economic fundamentals. However, as the Asian crisis brought high interest rates, bankruptcies, unemployment, and economic chaos to the afflicted nations, economic conditions soon changed, and the loss of confidence was retrospectively validated. It appeared that Soros's notion of reflexivity, where investors' perceptions serve to shape reality, was at work. Efficient marketers claim that foreign currency crises arise only when governments pursue poor policies, such as Britain's excessively high interest rates in 1992, or Russia's failure to collect taxes in 1998. In particular, they argue that foreign currency pegs are an open invitation to speculators, who probe any weakness they can find. Yet it is not only countries with currency pegs that have suffered from the herd-like activities of foreign exchange traders. Professor Paul Krugman of the Massachusetts Institute of Technology recently observed that the appreciation of the yen, an unmanaged currency, against the dollar from 120 in 1993 to 80 in 1995, and its subsequent decline to 120 in 1997, appeared to be the result of traders riding a trend rather than a reflection of changing economic fundamentals. The rise of the yen was extremely damaging to the Japanese economy at a time when the country could ill afford it. George Soros has claimed that, in a freely fluctuating exchange rate system, speculative transactions assume progressively greater weight, and, as they do, speculation becomes more trend-following in character, leading to progressively greater swings in exchange rates. Dangerous derivatives. According to most finance professors, derivatives perform a vital function in the capitalist system. In the age of floating exchange rates, which has followed the collapse of the Bretton Woods system, derivatives enable businesses to hedge their risk exposure and increase production. Professor Merton Miller, a Nobel laureate and a zealous defender of derivatives, observed recently that, contrary to the widely held perception, derivatives have made the world a safer place, not a more dangerous one. Federal Reserve Chairman Alan Greenspan also enthusiastically supported the unregulated growth of the derivatives market. Yet the economists' claim that derivatives are simply risk management tools does not withstand scrutiny. Such is the baffling complexity of many new derivatives products that even George Soros has declared that he used derivatives sparingly because he could not understand how they function. Financial risks that were formerly well understood have become arcane. Soros and others have argued that many new derivatives serve no purpose other than to facilitate speculation, in particular enabling fund managers to circumvent prudential restrictions on their investments. What conceivable risk exposure, it has been asked, is a LIBOR-cubed swap, a security that multiplies by 3 times changes in the London interbank offered rate, the rate of interest in the wholesale money market, designed to hedge? And to what bona fide purpose is a Texas hedge, a combination of 2 related derivatives positions whose risk is additive rather than offsetting? Over-the-counter options may also pose a threat to the investment banks that issue them. At the end of 1996, 10 US banks had nearly $16 trillion worth of derivatives on their books. These banks must continually hedge their positions by buying and selling the underlying assets, that is, shares, bonds, and currencies, from which the options derive their value. This activity, known as dynamic or delta hedging, requires the banks to sell the underlying assets when prices decline and buy when they rise. Soros warned that delta hedging sales during a market panic might cause a severe financial dislocation. The effectiveness of delta hedging depends on market liquidity, and the failure of portfolio insurance in October 1987 showed that liquidity might not be there when it was most desperately needed. The economist, Andrew Smithers, has argued that because this potential loss of liquidity is ignored, stock options are fundamentally mispriced. As a result, a severe market decline might precipitate bank failures. Smithers accused financial regulators of catastrophe myopia. Commenting on the growth of derivatives in Washington in May 1992, Dr. Henry Kaufman, the former chief economist at Salomon Brothers, declared that he could think of no other area that has the potential of creating greater havoc on a global basis if something goes wrong. In 1994, Gerald Corrigan, the former head of the New York Federal Reserve Bank, who was responsible for overseeing the Fed's rescue operation in October 1987, warned that the increasing complexity of financial markets could override the ability of the most sophisticated efforts to monitor and manage risk. A year later, Corrigan addressed a meeting of the International Monetary Fund. "There is little doubt in my mind that a repeat performance of the 1987 stock market crash would be more difficult to contain today." More recently, Alfred Steinherr, the author of Derivatives, The Wild Beast of Finance, 1998, described derivatives as the dynamite for financial crises and the fuse wire for international transmission at the same time. Unfortunately, the ignition trigger does not seem to be under control. The Federal Reserve, however, saw things differently and headed off moves to regulate the over-the-counter derivatives market. Hedge fund mania. Hedge funds are the most purely speculative investment vehicles of the late 20th century. Their managers trade in a variety of markets, foreign currencies, commodities, stocks and bonds, around the world. They do not make long-term investments, but aim to anticipate changes in the market's direction or ride a market trend, as the hedge fund's critics maintain. Although hedge funds have received the enthusiastic backing of the efficient marketers, several commentators believed that they were taking excessively large risks and contributing to the instability of the financial system. Since hedge fund managers generally receive a slice of investment profits, normally around 20%, but do not suffer losses, they are encouraged to assume ever greater risks. Soros warned of the asymmetry of risk and reward in his profession. In May 1994, he called on central banks to regulate the giant hedge funds. "I think," he added, "there is an innate instability in unregulated markets. It behooves the regulators to regulate." Dr. Henry Kaufman suggested that the unsound trading strategies of several hedge funds constituted what he called the soft underbelly of the financial system. In April 1994, William E. Dodge, the chief investment strategist at Dean Witter Reynolds, expressed his worries about the lack of information concerning the size of individual transactions and the terms of trade. "The dimensions of investing in hedge funds have become so big that if they fail, they would produce a systemic risk to the banking system and therefore endanger the financial structure of society." At the time, these warnings were ignored. Soros addressed his comments on the desirability of regulation to the House Committee on Banking in April 1994, but the Republicans' capture of Congress later in the year, assisted by generous campaign contributions from other hedge fund managers, killed off any further moves to regulate hedge funds. Alan Greenspan of the Federal Reserve also lobbied against hedge fund regulation on the grounds that it would only send the hedge funds offshore, where most were already registered, in order to avoid the scrutiny of financial regulators. In fact, federal rules were actually relaxed in 1996, allowing an increase in the maximum number of investors at individual hedge funds from 100 to 500. At the same time, a number of loopholes were exploited to attract less wealthy investors into the hedge fund game. Freed from the threat of regulation, hedge funds increased in number from fewer than 200 in 1990 to around 1,200 by the summer of 1998. During the same period, their funds under management rose from under $20 billion to around $120 billion. This figure understated their true influence, since the balance sheets of many hedge funds were leveraged several times over with debt, and derivatives gave them the ability to create an investment exposure far greater than their capital. During the bull market, most hedge funds successfully used their leverage to produce the stellar returns that made them so popular on Park Avenue. In 1997, Americans invested an extra $40 billion in hedge funds. A wake-up call. Criticisms of hedge funds increased after the Asian crisis of 1997, when several funds were accused of colluding together to drive down markets. Dr. Mahathir Mohamad, the Prime Minister of Malaysia, claimed that hedge fund managers were the highwaymen of the global economy. Although George Soros shrugged off Mahathir's accusations, denying that he had either contributed to or profited from the Asian crisis, the allegation that hedge funds were destabilizing foreign currencies did not go away. In the summer of 1998, the Hong Kong government insisted that its currency and stock market were under concerted attack by a group of hedge funds, and reacted by banning short sales of stocks and placing restrictions on the local futures market. Russia's twin default and devaluation in August 1998 brought fresh difficulties to the profession. Several hedge funds had made large investments in high-yielding, short-term Russian government debt, in the expectation that the Western powers would bail out Russia, on the principle that Russia was too big to fail. When these bonds became almost worthless, hedge funds were forced to dump their other investments in order to meet margin calls from their creditors, a problem similar to that which afflicted American margin speculators in October 1929. These forced sales transformed the Russian crisis into a global one, causing stock and bond markets to collapse. Investors, who a few months earlier had considered no risk too great, fled to the relative security of American and German government bonds. The great majority of hedge funds announced losses for August 1998. One fund, the aptly named High Risk Opportunities Hub Fund, was forced into liquidation. Among the larger funds caught out by the Russian crisis were Soros's Quantum Fund, which lost $2 billion in August, and Long-Term Capital Management, LTCM, a recently established operation managed by John Merriweather, a former vice chairman of Salomon Brothers. Merriweather had left Salomon after one of his bond traders was involved in an attempt to rig the market in U.S. Treasury notes in 1991, and subsequently established LTCM in the prosperous New York suburb of Greenwich, Connecticut, a town so popular with speculators that its exclusive seafront avenue was dubbed Hedge Row by the locals. Among Merriweather's partners were two former finance professors, Myron Scholes and Robert Merton, who in October 1997 shared the Nobel Prize in Economics for their contribution to the development of the derivatives market. At the time of the award, The Economist congratulated the professors for having turned risk management from a guessing game into a science. Other commentators were less enthusiastic. Alan Abelson at Barron's viewed the award with a jaundiced eye. The pair, wrote Abelson, snared the rich honour and the tidy sum that goes with it for devising a formula to measure the worth of a stock option, thus paving the way for both the spectacular growth of stock options and their use as instruments of mass destruction. The two guys who artfully contrived the ultimate temptation that fueled the crash of October 1987 just won the Nobel Prize. Happy anniversary! Equipped with the brightest traders and the leading theoretical minds in the financial world, Long-Term Capital Management attracted investments from the cream of Wall Street, including David Kamansky, head of Merrill Lynch, who along with 122 Merrill colleagues invested a total of $22 million, Donald Marin, chief executive of Paine Webber, and James Kane, chief executive of Bear Stearns. Other investors included the Bank of China, Bank Julius Baer, a private Swiss bank, Michael Ovitz, the former Hollywood agent, and a number of partners of McKinsey & Company, the management consultants. With such a glittering roster of investors, LTCM became known as the Rolls-Royce of hedge funds. The fund opened for business in early 1994. Its strategy, using mathematical techniques pioneered by Scholes and Merton, was to search for small valuation anomalies between various classes of bonds, dealing in bond derivatives known as total return swaps. The firm specialized in what were called convergence plays, going long and short on a variety of bonds in the expectation that their prices would converge. This was a backward-looking type of speculation, based on an extrapolation of historic price patterns. LTCM also went in for risk arbitrage, the business made famous by Ivan Boesky, which involved trading shares in takeover situations. The equity positions of LTCM were characterized as market neutral, meaning that it did not take bets on the overall movement of the stock market, but went long and short on a variety of stocks. In theory, this should have protected it from any market downturn. Initially, its trading strategy proved highly successful. In 1995 and 1996, the fund produced investment returns of 59% and 44% respectively. At the end of 1997, Merriweather was able to return $2.7 billion of capital to his original investors, retaining just under $5 billion for ongoing speculations. Later, it transpired that the fund had returned this capital without reducing its exposure, thereby increasing its leverage. The hedge fund's glorious progress came to an abrupt halt in early September 1998, when Merriweather announced that LTCM had lost around $2 billion, about half its capital, in the previous month. Putting on a show of bravado, Merriweather declared at the time that he continued to see outstanding investment prospects and would solicit investors for more funds. However, investors were not convinced, and 3 weeks later it was announced that the Federal Reserve Bank of New York had arranged for a consortium of leading investment banks, including Komansky's Merrill Lynch and Marin's Paine Webber, to inject $3.4 billion into LTCM in return for a 90% stake in the fund. At the same time, it was revealed that the hedge fund had built up liabilities of around $200 billion on a capital base that had shrunk to less than $1 billion. Several American investment banks had provided loans at 100% of the value of collateral offered by LTCM, so-called zero-margin loans. The banks had lent bountifully, without considering the other loans Merryweather and his partners were busy raising from their competitors. These loans, together with derivatives, allowed LTCM to build a position in the market estimated at $1.4 trillion. Soon after the bailout, several investment banks announced provisions against losses incurred from dealings with the hedge fund. Chief among them was UBS, formerly Union Bank of Switzerland, Europe's largest bank, which reported a loss of $686 million on a loan it had provided to Merryweather's partners. In true 1990s fashion, this was not a straightforward loan, but an unhedged, structured equity swap. Among the $541 million worth of investments LTCM made in U.S. stocks, a figure which excluded the fund's equity derivatives positions, was an $18 million stake in Bear Stearns, the brokerage firm, whose chief executive had a $10 million investment in LTCM. Revelations of the personal investments of Wall Street bosses in the hedge fund, the preferential treatment that the fund had received with its zero-margin loans, and the bankers' subsequent use of their shareholders' money to bail it out, thus preserving at least 10% of their personal investments, recalls the antics of Charles E. Mitchell and other Wall Street bankers in the 1920s. It is unfair, however, to suggest that Wall Street only came to the rescue of Merryweather in order to protect the personal investments of its top executives. The situation was, in fact, far more serious. It was suggested that the forced liquidation of LTCM's positions would have brought losses estimated at $14 trillion. Such losses would have severely disrupted the world's capital markets and threatened the bank's own proprietary trading positions, which were highly leveraged and closely resembled those of the hedge fund. In the end, the risk was too great to contemplate, and the bailout was swiftly arranged. Although there were no immediate resignations on Wall Street, only the chairman of UBS resigned, investors rapidly lost confidence in investment banks, whose shares declined by an average of more than 50% during the late summer and early autumn. Goldman Sachs, which a few months earlier had issued a report stating that hedge funds were safer than other forms of collective investment, was forced to delay its planned flotation. A few days after the bailout, Merrill Lynch announced 3,000 job cuts. Among the more curious revelations to emerge from the affair was the news that the Italian Central Bank had made investments and loans to LTCM. It turned out that Merryweather had employed an Italian economist, Alberto Giovannini, who had previously worked for the Italian Treasury, advising it on debt management, and that LTCM had made large purchases, estimated at $50 billion, of Italian government bonds. Such close arrangements posed the danger that insider information might be passing between the central bank and its hedge fund partner. The Italian central bank was not alone in forsaking its traditional role as the guardian of monetary stability in favor of the attractions of speculation. In the early 1990s, the Central Bank of Malaysia, the Bank Negara, was an aggressive speculator in foreign currencies, an activity from which it retired only after suffering heavy losses. Throughout the 1990s, central bankers around the world have indulged in their own form of speculation, selling gold, a declining asset, and using the proceeds to purchase U.S. Treasury bonds, a rising asset. As this strategy was similar to that of many hedge funds, it was perhaps not so surprising to find a central bank among LTCM's backers. In early 1999, the Brazilian central bank announced that its new president would be a former managing director of Soros's hedge fund. The standing of the U.S. Federal Reserve was also damaged by the LTCM affair. Among Merryweather's partners was a former vice chairman of the Federal Reserve named David Mullins. A few years earlier, Mullins had been responsible for the Fed's investigation into the Salomon bond rigging scandal, which had precipitated Merriweather's departure from the bank. At the time, the Department of Justice accused two large hedge funds, Steinhardt Management and the Caxton Corporation, of collaborating in the manipulation. They subsequently paid a $70 million fine without admitting wrongdoing. Presumably, Mullins found no conflict of interest in later accepting a job at a hedge fund from Salomon's former vice-chairman. In Japan, such behavior would have been quite conventional. Indeed, the Japanese have a word to describe the custom by which a government official takes a job in an industry he has formerly regulated. They call it amakudari, or descent from heaven. Mullins's friend and former colleague Alan Greenspan was also embarrassed by the events at LTCM. For several years, Greenspan had vigorously resisted calls to regulate both the derivatives markets and hedge fund activities. Only a couple of weeks before the bailout, Greenspan had insisted to Congress that hedge funds were, in his words, strongly regulated by those who lend the money. Yet the leverage at LTCM showed clearly that this was not the case. Throughout the years of the bull market, Greenspan had delivered a series of opaque and ambiguous speeches, half warning of the dangers of speculation and half congratulating America on its economic revival. After the LTCM bailout, complaints were raised that Greenspan had failed to do enough to stem the growth of a stock market bubble caused partly by excessive monetary growth. The reputation of the man who not long before had been described by a member of Congress as a national treasure was beginning to look as fragile as the stock market itself. Shortly after the bailout of long-term capital management, Paul Volcker, Greenspan's predecessor as Federal Reserve Chairman, asked, "Why should the weight of the federal government be brought to bear to help out a private investor?" No answer to Volcker's question was forthcoming, except that both Greenspan and Treasury Secretary Robert Rubin insisted that technically there was no bailout, since federal money had not been used. A few years earlier, the Federal Reserve had passively stood by while Drexel Burnham Lambert, an investment bank with some 5,000 employees and a history stretching back into the 19th century, was deserted by its envious Wall Street competitors and collapsed because of liquidity problems. Long-term capital management, on the other hand, a mere 4-year-old upstart with only 200 employees, but partners and investors drawn from a cabal of finance professors, central bankers, and the cream of Wall Street, was considered more important than Drexel and simply too big to fail. Echoing Pecora's accusation of Wall Street's heads I win, tails you lose ethics in the 1920s, Representative Bruce F. Vento, a Democrat of Minnesota, accused Greenspan of having two rules, a double standard, one for Main Street and another one for Wall Street. The Fed's involvement in the bailout of LTCM resembled the type of crony capitalism which the United States was continually decrying in Asian countries. Thus, at a crucial moment in the global financial crisis, the moral authority of the U.S. government and its ability to dictate economic policies to other nations were undermined. Naturally, the hedge fund industry did not emerge unscathed by the crisis at LTCM. According to their apologists, hedge funds were in the business of risk dispersal, yet Merriweather and his partners had concentrated risk in a manner similar to that of the negligent underwriters at the Corporation of Lloyd's in the 1980s. In fact, the notion that speculators can effectively serve as insurers against financial risks is flawed. Whereas a life insurer can confidently write policies based on actuarial tables derived from slowly changing death rates, the speculator has only poor statistical information upon which to base his strategy. Moreover, the activities of other speculators are constantly changing conditions in the market, thereby making the past an unreliable guide to the future. In the end, the banks which hedged their positions with LTCM were obliged to take over their insurer in order to secure their own survival. Liberal economists also claimed that hedge funds provided liquidity to the world's financial markets. Yet while LTCM teetered on the brink of collapse, the markets in which it operated, high-yield bonds, emerging market debt, convertible securities, and mortgage-backed issues, became paralyzed as liquidity dried up. The effect of this was to raise the cost of capital for corporations. Even after the bailout, the financial markets remained stormy due to a flight to safety, as investors eschewed long-term risks in favor of cash, bringing turbulence to the world's stock and bond markets. Many hedge funds had financed their speculations by borrowing cheaply in Japanese yen. After the bailout, these hedge funds were forced by their creditors to unwind their leveraged positions, causing a 20% fall in the dollar against the yen in 1 week in October. Never before had the world's leading currency markets exhibited such extreme volatility. At a hedge fund conference held in Bermuda shortly after the bailout, originally entitled How to Handle the Flood of Assets Coming In, but hastily restyled Crisis and Corrections, Implications for Hedge Funds, Julian Robertson, head of the Tiger Fund, the world's largest hedge fund, joined Soros's call for greater regulation of the industry. The LTCM affair also raised questions about the fast-growing derivatives market. As we have seen, finance professors claimed that derivatives were seldom used for speculative purposes. Yet Merriweather's hedge fund, run by the world's leading risk management experts, had used derivatives wantonly to build up the largest and most leveraged positions in the history of speculation. The leverage within LTCM was reported to exceed $100 of debt for every dollar of equity, and much of the partners' equity investment turned out to be borrowed money. The near bankruptcy of long-term capital management reflects the near bankruptcy of the intellectual principles upon which it had been built. The flaw in the hedge fund's trading strategies was to assume that the historical relationships between various assets could be depended upon for future speculations. The hedge fund was so confident of its opinion that it took massive bets when its computers identified small divergences from the norm. The formula for pricing options, developed by Scholes and Merton, which lies at the heart of the modern derivatives world, is dependent on the similar assumption that past volatility is a reliable guide to future volatility. This assumption may be likened to driving a motor car by looking in the rearview mirror, fine as long as the road continues straight, but disastrous when you reach the first corner. In common with all the practical ideas generated by the efficient market hypothesis, it is based on the belief that when financial theories are turned into practice, there is no change to the underlying reality. This was the era of portfolio insurance in the 1980s, and remained the era of the derivatives market a decade later. If markets are not efficient, but are subject to chaotic feedback loops, then the entire financial superstructure created around derivatives in the 1990s, with its $50 trillion worth of exposure, is based on shaky premises. Even outside the field of options pricing, the teaching of the efficient market hypothesis has insinuated itself into the practices of modern finance. The fads for shareholder value and corporate stock option schemes, the capital asset pricing model, which scientifically calculates companies' cost of capital, and popular investment in stock index funds are all predicated, to a greater or lesser extent, on the assumption that shares are efficiently priced by the market. But if the hypothesis is false, for example, because speculative euphoria does in fact drive share prices away from their intrinsic value, then these practices are in need of reform. Recently, James Buchan asserted that political economy is in the same condition in which scholastic learning found itself on the eve of the discoveries. It is about to explode. The crisis at long-term capital management suggested that the final refutation of modern economic theory might only be achieved by an implosion of the financial system. As the head of a risk management firm told the New York Times, the crisis was a wake-up call. He chose his words well. The Third Degree. Unlike Merton and Scholes, John Maynard Keynes's personal and successful experience of speculation led him to the conclusion that markets were fundamentally inefficient. In his general theory, Keynes defined speculation as the attempt to forecast changes in the psychology of the market. He compared it to various parlour games, snap, old maid, and musical chairs. Switching his metaphor, Keynes likened speculation to a newspaper competition in which the competitors have to pick out the 6 prettiest faces from hundreds of photographs, so that each competitor has to pick not the faces which he himself finds prettiest, but those which he thinks likeliest to catch the fancy of the other competitors, all of whom are looking at the problem from the same point of view. We have reached the third degree, where we devote our intelligences to anticipating what average opinion expects the average opinion to be. Speculation, which is a beneficial, indeed vital component of the capitalist process, has come to dominate the system to an unhealthy degree. To repeat Keynes's warning from the 1930s, when the capital development of a country becomes a byproduct of the activities of a casino, the job is likely to be ill done. Momentum trading, trend-following currency speculators, over-leveraged hedge funds, and corporate managements obsessed with daily fluctuations in share quotations are unlikely to produce the optimal distribution of scarce resources in the global economy. We have reached Keynes's third degree. Politicians and economists, pondering the problems caused by unfettered speculation, face an old dilemma. As Alexander Baring, head of the family bank lately brought down by Nick Leeson, remarked in 1825, any attempt to check speculation might be counterproductive. The remedy would be worse than the disease if, in putting a stop to this evil, they, the authorities, put a stop to the spirit of enterprise. Governments have frequently attempted to control speculation by outlawing its tools and practices. Yet on each occasion, speculators have found ways to circumvent regulations. They have also interpreted laws against speculation as a sign of weakness on the part of governments, which has caused them to step up their activities. Keynes whimsically proposed that speculation might be discouraged if people were forced to make investments, like marriage, for life, a solution which would have produced a lifetime of frustration for those unfortunate enough to make a poor initial choice. More seriously, he considered a penal rate of capital gains tax on short-term holdings. As we have seen, however, high rates of capital gains tax on short-term property investments in Japan actually stimulated the Tokyo property boom in the 1980s by reducing liquidity in the market. It is arguable that taxes on capital gains actually contribute to stock market bubbles, since investors with large profits become reluctant to sell even when they believe stocks are overvalued. Keynes also suggested that a transaction tax be levied on U.S. share purchases, on the grounds that casinos should, in the public interest, be inaccessible and expensive. Several economists argue that central bankers should consider asset prices along with consumer prices in their inflation targets. The problem with this suggestion is that nobody can prove definitively that share prices are rising because of speculative pressure rather than a genuinely improved outlook. As Alan Greenspan asked in December 1996, how do we know when irrational exuberance has unduly escalated asset values? Only in retrospect does the answer to this question become clear. Furthermore, the central banker's main tool for controlling speculation is raising interest rates. As long as speculators continue to anticipate large profits from capital gains, they are not deterred by high interest rates. And, as Keynes observed in the 1930s, raising interest rates to control speculation at the end of the business cycle damages the whole economy. The only other tool left to central bankers is to issue warnings to speculators to desist from their activities, what was called moral suasion in the 1920s. Time and time again, such warnings have been made by the authorities, and on no occasion have speculators heeded a word. During the Great Depression, American policymakers decided that speculation was best controlled by limiting the speculators' access to financial leverage. As a result, margin loans were limited by federal law to 50% of stock values. This policy has since broken down with the advent of financial derivatives, as the case of LTCM demonstrates in extremis. It has recently been proposed that derivatives should be subject to the same margin limits as conventional stock purchases. Restrictions on speculators' ability to achieve almost limitless leverage through the derivatives market might lessen the risk of systemic crisis in the financial world. Improved information in the almost unregulated derivatives world would also hinder the excessive accumulation of debt, such as occurred at LTCM. The issue of speculation in emerging markets and the unfettered trade in foreign currencies is the most immediate and vexing problem faced by policymakers. Politicians and central bankers worry about how to achieve economic stability without inhibiting the flexibility necessary for growth. Yet flows of speculative capital into fragile emerging markets have not brought any visible long-term benefits. Indeed, it can be argued that they have actually hindered the evolution of the liberal market system in many countries. In this instance, speculation has been no friend of capitalism. There have been a number of proposals, of varying degrees of practicality, about how best to deal with the problems of foreign currency instability. The reintroduction of capital controls, controls on foreign borrowing, improved accountancy and less cronyism in emerging markets, a tax on capital inflows into emerging markets, a tax on foreign exchange transactions, controls on hedge funds, the reform of the International Monetary Fund so it can perform effectively the function of lender of the last resort, and even the establishment of a world central bank are among the ideas floated by policymakers who appeared wrong-footed by the unexpected appearance of a world financial crisis. Dominique Strauss-Kahn, the French finance minister, has called for the construction of a new Bretton Woods. Although a new system of fixed currencies would necessitate a degree of capital controls, there is no evidence that this would actually inhibit economic growth. In fact, the growth rates of Western nations have actually declined since the early 1970s. Providing currencies with fixed values would also obviate the need for derivatives, which could be allowed to wither on the vine without posing any further threat to the financial system. European businesses are the keenest supporters of the European single currency project because it saves them the cost and uncertainty of hedging their trading operations in the derivatives markets. Investors in foreign countries might forgive capital controls and restrictions on the early withdrawal of investments if they had greater confidence that economic conditions in these countries would not be suddenly undermined by speculative currency attacks. A fixed currency system would also define the limits of speculation in the manner performed by the gold standard in the 19th century. When the tide turns against the speculator, there is an inevitable loss of liberty. In The Road to Serfdom, first published in 1949, the Austrian economist Friedrich von Hayek declared that state control of foreign exchange dealing was a decisive advance on the path to totalitarianism and the suppression of individual liberty. Hayek believed that from a mixed economy there would be an inevitable progression to socialism. History has proved Hayek wrong. His analysis underestimated the power of speculation, even in quasi-socialist economies, to pull in the opposite direction. Speculation undermined the Bretton Woods system of fixed currencies, and more recently, it has destroyed the state-managed capitalism of Japan and other Asian nations. As an anarchic force, speculation demands continuing government restrictions, but inevitably it will break any chains and run amok. The pendulum swings back and forth between economic liberty and constraint.